Morning, everyone. Welcome to the Genus monthly webinar. My name is Ian Lusher. We will be starting in roughly 1 minute, maybe two. We're just giving everyone a chance to come in, and then we will start. Once again, good morning, everyone. Welcome to the Genus monthly webinar. We will be starting in roughly 45 seconds, just giving everyone a chance to come in. Okay, well, it's time to get started. There will be more people joining us, I'm sure, as we go on. Good morning, everyone. Welcome to the Genus monthly webinar, Your Investments in Insurance. My name is Ian Lusher. I'm a portfolio manager and a partner at Genus Capital Management, and I'm hosting today's session. I'm pretty much a moderator today, won't be talking that much. I'm joined by our panelists, Cindy David from Cindy David Financial Group, Warren Campbell from Cove Community Advisors Inc., and Nancy Fong from NYF Wealth Management. Today we'll be exploring the sometimes contentious topic of insurance, including how to explore insurance solutions and options, how to use insurance for tax planning, and what role insurance can play in your portfolio. At the end of this, we've left a good amount of time for your questions. I'm sure there'll be many questions in the chat. Graham will be monitoring the questions, and I will as well. I'll do my best to bring all of the questions up if time permits. We've added links to connect to all our panelists and myself on social media in the chat, and I'd encourage you to reach out to us if you have any questions or just comments. Okay, so before we jump into this topic, let's take care of a few housekeeping. We've found whenever you go on these webinars that it's best to maximize the screen for your viewing experience. As I mentioned, if you have any questions, just type those questions in the chat at any time, and we'll spend some time together answering those questions. If we do not get to your question, we will answer it, and we will send you an answer to that question offline. If you're having any technical trouble, you can let us know through the chat, and we'll have someone on hand to try and assist you. One solution that we found is to just hop off of the webinar and then come back on if you're having any video or audio troubles. Now, before we start, I'd like to do a land acknowledgement. I'd like to start by extending my gratitude to the Indigenous peoples, specifically the Tsleil-Waututh, Squamish, and Musqueam, whose land I'm honored to speak to you today. We do this to reaffirm our commitment and responsibility in improving relationships between nations and our own understanding of local Indigenous peoples and their cultures. Canada is home to Indigenous people from across Turtle Island, and we are grateful to have the opportunity to meet and work on this territory. Okay, let's get started. I'm going to give a brief introduction to the topic, what we're actually trying to do here. From the outset, this isn't a sales presentation. This is a discussion about using insurance strategically to enhance your wealth and estate plan. Some of the common concepts that we're talking about today may apply to you and some may not. So the goal of this webinar is to bring to your attention some insurance strategies that may resonate with you or may actually resonate with someone you know, maybe a family member, both younger or older, and those that are relevant to you that maybe previously you've never come across. Each of our speakers will spend a short amount of time introducing themselves and introducing an insurance specialty or a strategy that summit and attendees may find interesting. Once we go through that introduction period, we'll have a few moderated question and answer period with myself, time permitting. And then we will take a look at all of the questions in the chat and see what we can get to and have time for. So we've allotted lots of time for questions. I have lots of questions. I'm sure you have lots of questions. So let's get started. I will put it over to Cindy as our first presenter. Welcome.
Thank you. All right. So we've been given a very short amount of time to speak on a subject that we all of the panelists could spend hours talking to you about. So I am going to go through everything really quickly. Please feel free to shoot me a note on LinkedIn if you want any clarification for anything that I've said. Bit of background on me. I've been in this business for 30 years. I'm a retirement, estate, and insurance specialist. Don't be alarmed at the 30 years. I've only got 25 more to go, so I feel like I'm just getting warmed up. I am designated on a few fronts. I have my certified financial planning designation, my chartered life underwriting designation. Sounds like a life insurance underwriting designation, but it really, for me, that was where I learned a lot about insurance and planning for business owners. I am a family enterprise advisor, and I am a member of STEP, which is the Society for Trust and Estate Practitioners. So that designation is the TEP. So lots of alphabet soup behind my my name on my business card. I'm also a recent past chair of the Conference for Advanced Life Underwriting, which is the advocate for the insurance industry to the federal government. We work on legislation on behalf of you, our clients, and our colleagues in our industry to protect what we do from silly decisions in government. We know that happens occasionally. I'm used to collaborations. So one of the reasons I'm here is I do collaborate a lot with portfolio managers to make sure that our clients are getting all of the advice that they need. And this has really become a very complicated industry. And I think it's important that our clients work with specialists who are the best at what they do and don't try to do everything. I'm in charge of my own slides, so I will go to the next slide. So a lot of people say, I'm not going to let you cheat. I'm the one letting you cheat. A lot of people say, you know, life insurance is too expensive, or I'm not going to qualify. Those are the two main things that we hear primarily. So I'm going to walk you through why, you know, what would life insurance cost, give you an example, and hopefully prove to you that life insurance is not too expensive. And you know, we're not looking for triathletes. We are looking for people that are healthy for your age. And that typically means for a lot of our clients north of age 60 that you could be on some medications, and that's okay. You can still get a standard offer for insurance, and that's quite normal for us. So I've put together an example of a male and female who are both age 60 looking for $1 million of life insurance. So let's look at what that would cost. I'm assuming this is a male and female that were a couple, and I want to show you what the cost would be if they were to buy the coverage on their own. So $1 million of coverage of permanent coverage for a female age 60 would be $18,827 a year, every year for the rest of your life. Don't fall off your chairs. We're going to get to a better price, but it can be expensive for an individual, especially once you get into higher ages, to buy insurance on their own life. Warren's going to talk to us later about different ways we can make it less expensive using collateral in some cases. Males are more expensive because us females live longer, and that's because we talk about our feelings. Here's where I find most people actually purchase insurance on a joint last to die basis, where we do have a couple who have a combined estate and the tax bill isn't due until the second death. There are spousal rollover provisions built into the Income Tax Act that allow pretty much everything you own. That's a very broad statement, but a lot of what you own can be transferred to your spouse when one of you dies. It's not until the second death that taxes typically kick in, with exceptions, of course. So a much better pricing if we use joint last to die. The question then becomes, is this a good use of my money? Is it a good idea for me to spend almost $14,000 a year for the rest of my life? Should I just save it? So I'm going to show you what savings would equate to. If you invested that same premium in a 4% GIC for life, you would have saved $576,000. That is the after-tax portion of the GIC that would be available in your estate to pay presumably $1 million of estate tax. If you're looking for $1 million of insurance, it's because you have $1 million tax bill. So if you compare the two, that tells me that insurance is still a good idea. You can also use insurance as an investment to help pay for all of those future costs. So if you say to me, I don't really like the idea of writing a check every year to the insurance company for $14,000, is there any way I can sort of one and done it? Typically not one and done. That's very difficult, but we can prepay insurance over a 10, 15, or 20-year period. And I do find a lot of my clients are choosing to prepay insurance over a 10-year period. And the reason why is there's an additional tax benefit to you in doing so. I'm going to explain how this works from a product perspective. But if you were to choose to prepay it, give up a lot more of your money than just $14,000 a year for life, you'd have to write a check for $72,755 for 10 years, but then you're bought and paid for. So again, I'm not sure that's, yeah, right. I'm sorry, I might have missed that number, but trying to compare that GIC number at age 90, and I can't see my slide because so in this scenario, because you're prepaying the insurance, you're creating an investment account that grows tax-free like your TFSA. That goes to actually increasing the amount of insurance that you have over time. So in that case, you're not just buying $1 million of coverage, you're starting with $1 million of coverage, but ending up with $4 million of insurance. This is tax-free and liquid to your estate. So if you're worried about your beneficiaries having to cash in RSPs at a bad time in the market to pay for a tax bill, or having to liquidate real estate at a time where real estate is not too liquid, that's what people use insurance for. The added benefit here is you don't just have insurance, you have cash. You've been prepaying an insurance policy, but you're building up your own slush fund for if you run out of money, if you spend your RSPs too soon, too fast, or I'm going on my first cruise tomorrow. If those cruises start to add up, and you want more money for travel down the road, you can actually use insurance as a way to build up a retirement fund reserve. The pre-tax equivalent return for this prepayment plan is actually 8.72%. And that's based on today's dividend scale with a whole life plan that would require another half an hour at least for me to explain to you. But if anybody wants a conversation around what is the difference between a universal life plan or a whole life plan, the different types of plans you can buy, we can talk about that.
Hey, Sadie, just letting you know we're
running out of time.
Yeah.
Sorry, I told you we could go on and on. Okay. Yeah. I only have one more slide, but I wanted to just make sure everybody understands that you can use insurance as an investment. There there are two different components to any insurance plan that is permanent. There always has to be a basis for insurance, but you can use a cash value component. That cash value at the top of the bucket is like a supersized TFSA. It grows tax-free. And when you die owning that cash value, it gets paid to your beneficiaries tax-free. So from a tax perspective, it's very similar. This relationship between insurance and cash value is governed by something called the maximum tax actuarial reserve. Nobody has to remember that on the line. I just want you to know that it exists. It's a section in the Income Tax Act that the government allows for you to buy insurance and save to this tax shelter. Now, you can't buy $1 of insurance and put $1 million into the tax shelter. This section of the Income Tax Act dictates how much insurance you have to buy and how much deposit room you can get into that tax shelter. So I think I'll leave it at that because I've already exhausted my time. It's unbelievable. These are the reasons, though, which is my segue for my other colleagues speaking next. Do you really need insurance? The reason my clients buy insurance is for liquidity to pay estate taxes. When you don't know when you're going to die, this is the first money that goes into the bank to help pay for bills. If you're going to use insurance as an investment, we do like to prefer for it to be never money. So if you're sitting on a big bucket of non-registered taxable investments that's driving you crazy, where you have to pay the tax every year, but you're not spending it, insurance is a great parking spot. Insurance can also be used to create a legacy for charity. So you can, instead of just giving your dollar, you can put your dollar and make it a ×4 kind of effect. And you can also leverage insurance, which Warren is going to talk about, and in some cases make insurance free as a cost. So I'm getting the coat hook, and thanks for my 3 or 4 minutes.
Thanks, Cindy. We'll move on to Warren. Welcome, Warren.
Thanks, Ian. Good morning, everyone, and very happy to be participating in this webinar. So let's talk a bit first about Cove. At Cove, we believe that we are unique in the insurance space. As the first insurance agency to be a B Corp, we balance profit and purpose. As the slide shows there, we're also members of 1% for the planet and 1% for people. And we are a proponent of transparency and accountability in everything we do, including the insurance products that we sell. We believe in providing the greatest level of transparency possible, whether that's on our compensation and commissions or the insurance coverage we propose and recommend. Our approach really is to provide a personalized insurance plan for every client, using insurance products that are accountable and transparent to us as advisors and to clients. And that means we need really strong contract language. And we're looking at which plans work best for clients. That's what we look at first. And we're very happy about, so what we've built in our business is a plan to serve generations of clients to come. That comes in our 7-generation plan. I am the 2nd generation. Bernie and Christy are the 1st generation, and Shannon and Nikki are our 3rd generation. And they're also leaders in our women's division. Now, not every insurance plan is right for every client. So we'll leave a bit about more of that to the Q&As. But what we do is we custom design the plan based on many factors, including the client's purpose, objectives, time frame, cash flow, and many more. It's very difficult to, at the very beginning, say this planner is best for you until we know a lot more about what's going on. Part of this process is matching the purpose to the product. A very simplified example of this is that if you have a short-term need, then you typically go for short-term insurance, term insurance. For longer-term needs, there's permanent insurance. And we don't typically recommend life insurance solely for investment purposes. But there are 2 instances where the investment part of the insurance becomes very, very valuable. That is when we have the plan is designed for the cash value to fund for future premiums, as Cindy mentioned earlier, or if the policy is going to be leveraged. So leverage is a very complex thing, and you're probably very happy that I don't have all the leveraging slides to go over you right now. But what we do is we're really taking advantage of the tax-sheltered cash value inside the policy and giving you the availability to invest that money in any investment possible. The side products of what this is, as Cindy mentioned, is it can reduce the cash flow required to fund the insurance. And where we have an insurance need, it's become very, very powerful. This is an area where we have a lot of specialty and worked in the loan setup and loan management for over 20 years. And specifically in the leverage market, there is a new product that's been available for the past couple of months that really, really shines using this strategy. And that's the product we typically would recommend, again, if everything checks the box and you're looking for that leveraged idea.
Oh, you are fast, Warren.
In a nutshell.
Very impressive. That's okay. We'll get back to you with questions shortly. On to you, Nancy.
Well, thank you for having me today. Cindy mentioned that one of the items that we can use life insurance for is leaving a legacy. So introducing myself, you can see my alphabet soup behind my name, but I was a lawyer for 12 years. And so I have direct experience in doing business transactions, wills and estates. And because I had a young family, I decided to go into the financial services industry. So I became a financial planner, and my view is that planning your financial and estate matters can minimize cost and stress, and that's very important for families. And my expertise is using life insurance, particularly for plan giving and tax planning. So I'm going to just move on to the slide. So how can life insurance enhance your estate? So there's 3 points in time that I think that it can be very useful. So during your lifetime, a life insurance policy can be a good tool to reduce your current taxable income yearly, because if you have a life insurance policy and you pay for the premium, but you gift the life insurance policy to a charity, you will get a donation receipt from that charity annually for the amount of the premium. Another way is some people already have a life insurance policy, and as Warren said, they had a purpose. My children are young, and if I pass away, I want to protect them. But when I'm getting older, maybe those reasons have changed. And so instead of protecting family, I can protect a charity. So I can donate an existing policy. What's the receipt that I will get? It will be the cash value of that policy. So as Cindy said, the top of the bucket. And the second time, you can do a new policy and donate, or donate an existing policy. The second time is for your estate, and that's the important part, to pay the estate taxes. But if you use that death benefit to donate to a charity, your estate will receive the donation receipt for the death benefit. And the other way is, well, I don't have that much estate tax upon, say, death of the couple, because I've done really good tax planning during my lifetime. But my kids will have very high income, and when they inherit what I'm giving them, they're going to have high tax. So the other way is for your heir to receive the amount that you intend to give to a charity, and the heir can donate the amount and receive their receipt to offset their taxes. So that's another way. And the last way is to give a gift, but also to replenish for beneficiaries. So what Winston Churchill says is, you make a life by what you receive, but we make a living by what we make, and we make a life by what we give. Sorry, I tried to memorize it, and didn't work. So what you can do is donate a gift from your estate through your will and receive a donation receipt. So right in the will, it can be a bequest, but you can buy life insurance to replenish that amount by designating your children or your heirs as that beneficiary. So there's many different ways, and as we mentioned, it's best to work with an insurance specialist who's very experienced in these areas. And so what are the benefits of using life insurance for planned giving? Well, it's certainty that a gift to a charity will be given and not challenged by the family. So we've heard of stories where in the will, they've added a charity and then the children aren't very happy about it and they can do a wills variation. The second one is two of my examples were you're alive when you give the donation, and that's the best, right? You want to be acknowledged for the gift you give. So when we use the life insurance, you kind of get both. You eat your cake and get it too. So the third one, which as a family enterprise advisor, I feel is very important, is sharing your values and generosity with your family. That's legacy. And the last one is tax advantage. For a donation, I looked into the 2022 numbers. A donation of $10,000 in BC could save as much as $4,528 of tax. And that's it.
Thank you. Very interesting. Actually, three very different strategies and angles and talks by the three of you. So I have a question for Nancy. Before we started doing this, came up with this idea, and when it was first presented to me, the first thing I thought about when I was going to have a bunch of insurance agents in a meeting is my first exposure was in cartoons back in the day. Daffy Duck was an insurance salesman, and really high pressure and all this stuff. We get these things in our head, right? So what would you say to, and there's a lot of people, what would you say to somebody who has reluctance to use insurance in any way, shape, or form? So they just have the walls up before they even are presented a concept, possibly because of past bad experiences or they watch too many cartoons as a young child. One of the two.
Well, I guess I'm the pot calling the kettle black because I used to be a lawyer, so a lot of people have aversions to lawyers as well. But what I would say is that you don't know what you don't know. And often insurance has this bad rap because it's high pressure sales. However, if you work with experts and specialists like Warren, Cindy, and I, we have other designations. So we're designated as certified financial planners, meaning we can just make a financial plan for you and not sell any insurance. But what I would say is it's a different type of asset. So what are the asset classes that we know? There's home, there's real property as rental, there's securities is what you guys do. There's art, but one of the assets and the one that works the best for paying final taxes is life insurance because it doesn't trigger until it's death. And in Canada, there is no estate tax, but the final year you're alive, there's the final deceased person's income tax return. That's when CRA goes, thank you very much. Please give me what you owe us during your lifetime. And if there's not enough liquidity in the estate, guess who has to take care of it is the heirs.
Okay, yeah, thanks, Nancy. I like the way that you explain that it's just another asset class, really. Sounds to me like you're just saying that it's another piece to the puzzle.
Well, actually, I'll add to that. That's a great thing that Nancy said, because it's been a big focus in the insurance industry, such that Sun Life spent a lot of time on creating a white paper that is called Whole Life as an Asset Class. It's very comprehensive and explains why you can consider it another part of your portfolio. If anybody would like a copy of that, will be providing that to Genus today, and you can request it from your portfolio manager or Ian.
Yeah, thanks, Andy. Before I get to the next question, just a reminder to all those that are on the webinar that if you have any questions, just put those in the chat and we will get them in the, we already have a few up already. So we will have lots of time to get to your questions. Warren, you mentioned a few things that were interesting. One, you kind of glossed over this, but I'd like to kind of open up the hood on this a little bit. You talked about helping clients choose the best insurance plan. And I also noticed you talked a lot about transparency, and I noticed on one of your slides that you're transparent with commission. So a couple questions is, how do you at Cove go about making sure that the client does get the best insurance plan for them? And is it typical to have transparent commissions in this industry?
Yeah, great questions. And let's start with the insurance plan first. When we're sitting down with clients, talk about the various insurance options available, one of the very first things we tell people is to try and forget everything you know about insurance. Because typically people resonate with a name or a type of insurance. It's whole life, it's universal life, it's participating, or even some of the insurance company names like Wealth Achiever or Life Dimensions. We try and tell people just to forget all about that. Because since the new tax rules came into force in 2017, we've seen some blending of insurance plans, and they're really like, it looks like one plan, but acts like another, and it's called something totally different. So what we try and do is, because we're completely agnostic, right? I mean, we're brokers. We work through what's called managed general agencies. All three of us do, and we can sell any company's products from any company. So really, it comes down to looking at the very plan specifics. So we try and get very qualitative before we get quantitative, right? What does the plan do? How is it designed? What are its attributes? And we look at such things like guaranteed insurance costs versus non-guaranteed, or guaranteed cash values embedded in the plan. Do I want to have a level insurance benefit or an increasing insurance benefit? Do I want to have one investment options for my cash value or multiple? And when we do that, we can narrow down the choices in the market to, 2 or 3 or 4 different plan designs where the client says, I think I like that. And then we get into the numbers side of it and look at, again, the quantitative side of it. And sometimes a client who may have thought, oh, this plan is right for me, looks at the numbers and say, that doesn't quite make sense. Or it could be the opposite. So really for us, it's a matter of education, walking that client down a journey. We're going to provide our expert advice on what we see for clients typically in that situation or are looking for something in that specific area. But ultimately, what we want the client to do is feel very, very comfortable when they've made that decision and implemented the insurance and feel that, yeah, they've created that space to breathe and they're very, very happy with that decision. Now, one thing that comes into the part about buying insurance is that, pressure salesman or the commission side of it, which is where we try and help clients, again, feel at ease with this. So many people don't know how life insurance is paid, or some people feel we get too much. And so we break down in our reports, how that commission is paid, including the fact that if they change their mind, all or substantially all of our commission in those early years is completely taken away. So we really, again, try and help them see that this is, again, for them and their grandchildren for years and generations to come. And yeah, there may be a big dollar figure commission wise, but it's to serve them forever. It's not overly common in the insurance space to be transparent on commission. I know some people do it, some people do it high level, some people do all the details, but in the people that I've talked to since we announced our transparency on commission a few years ago, I haven't heard of many people doing it, no.
Okay, yeah, because that's obviously in the investment industry, transparency is front and center, and I'm quite sure it'll spread along other industries, but typically that's something that clients will bring up when it involves insurance policies. So good to know that it's becoming available and transparency is there. I have a question for Cindy. I was going to ask you a question that was in the moderation, but I can see you're talking with Stan. So he had a good question that he had directed towards you. Basically what he said is it's hard to argue with the numbers that you presented, but what are the disadvantages? Obviously on paper, what you presented is, no brainer. But what situations would a client say, maybe that particular plan doesn't work for me, even though the numbers look good?
Well, the numbers are the black and white part of insurance. Either you like it or you don't. If you like the result that it can yield, you have to remember that insurance is a contract that is backed by law. The contract can't be changed once you've bound an insurance company to it. So I'd say the biggest hurdle, it's more of a hurdle, not a negative thing, is that you can like insurance results as an investment, or just even if you want to pay the minimum premium, you can still like those results because you're interested in the liquidity. But you have to qualify for this investment medically. So Ian, I don't think you have to put any of your clients through medical underwriting and have a nurse come to see them. That's really the biggest challenge, is once you decide that you do like it, now you have to qualify, and then the numbers can change. So I like to get clients to that point where they think insurance is enough of a good idea that they're willing to subject themselves to underwriting before we spend too much time making decisions, because your decision isn't necessarily final. If the numbers can change after a 1 or 2 or 3 month underwriting period, once you have an offer on the table, that's when you get to decide whether or not you want to bind an insurance company to that deal.
Okay, yeah, that makes
I
sense.
also, just looking at the questions, I don't know if you want me to address this now, about insured annuities. I got some answers on whether or not insured annuities have changed. I've been madly
just for everyone,
my office.
if you want to answer that, just for everyone, I'll actually tell everybody what question you're referring to. So one of the questions from Mark, he was asking if we'll be discussing insured annuities, where you buy both insurance policy and an annuity, and does it make sense with higher rates for annuities? So I'll let Cindy answer that one because you brought it up. But if either Nancy or Warren has any comments after Cindy, then that would be appreciated.
Yeah, so the answer, the quick answer is yes. I know it's shocking to hear a quick answer out of me, but it's not always just based on short-term interest rate changes. The bond or the insured annuities are based on the bond curve, the 30-year bond curve. And if the curve is flat, you're not going to see much difference when short-term interest rates change. When the curve starts to have more curve in it, and there's interest rate changes, then you're going to see some improvement in insured annuity rates. So using the same example that I did in my presentation, for a male and female age 60, if you were to buy a $1 million insured annuity, the pre-tax rate of return would be 7.44%. So pros about that, 7.44% is pretty good in a year following 2022, where everybody had a hard time making money in the markets. And if you're used to the equity capital markets, you can expect flat or down years every 4 or 5 years. If that makes you uncomfortable and you're a GIC investor, 7.44% for life is a decent return to lock into. That's for a joint example. So in the past, we found an example from 2019 for a couple who is actually older. Now, insured annuities are like red wine. They get better with age. So we found an example for a couple in their age 67. And in 2019, that pre-tax return was only 4.73. So that tells me the answer is absolutely yes. Right now is a better time than it has been in a long time to start looking at insured annuities. We'll probably be doing a blog on our website and LinkedIn on this because I like that return. I think that's, when you get to a pre-tax return, that is something that an investment or portfolio manager can't look you in the eye and guarantee you. That's what you get with an insured annuity, is you get the guarantee. You also get liquidity in your estate, right? You get that insurance benefit in the end, returning all your capital to you after you've spent the cash flow in the meantime.
And I'll just add to that. I mean, we're watching insured annuities very closely, and part of the component of that is the insurance cost, which is your typical level cost of insurance or Term 100. The pricing of those started increasing when we started seeing the historically low interest rates. As interest rates start going up and presumably keep high for a period of time, we could see price reductions in level cost of insurance products. So not only are we seeing potentially increasing it in the annuity rates, but we could see decreasing in the insurance rates, which could even further enhance the product. So we continue to monitor it. It's moving all the time, and it just comes down to things Cindy talked about, which is locking in capital for locked in rates, and is that appropriate for the client situation?
May I add something?
Yeah, that's a good point. Go ahead, Nancy.
So Cindy mentioned the insured annuity. That's also one of the plan giving strategies that we can use to replenish, the heirs part. There's certain strategies, but what I'd like to say is that all three of us, the main message is first, is there a need for insurance? So how I explain it sometimes to my clients is that, do you need a car, right? So if you don't even need a car, you like bicycles, you like walking, then insurance may not be the right vehicle. After you determine the car, then you might think, what type of car? Do I want a hybrid? Do I want an SUV? Or do I want this mega luxury car? That's really like whole life versus term versus UL. What need do I have it for? And then the last one is the cost, right? Do I add all the options, or I just take it, plain? So I think the process, exactly as Cindy said, is you can't determine what model and make and all the options until you know what the price is. So first of all, do you need a car? What kind of car? What type of car? And then which car?
Right. Good answer. We have lots of questions, so we'll try to get through them. I'll try to direct them to one person, and then if one of you has a something else you'd like to chime in on it, but we do actually have several questions here that are quite good. Here's one. I'm not sure. Maybe I'll just direct this one towards Warren. If you have a term policy, can you convert it to permanent insurance without having to requalify for the insurance with the medical?
Yeah, so important to look at the contractual provisions that Cindy mentioned earlier. So if it's a convertible policy, you can exchange it to a permanent policy within the time frame. So typically you're going to have that conversion options listed in the policy contract. There's going to be an age by which you can do that by. And so at any time before that age, you can simply fill out a piece of paper, send back your term policy, and get the permanent cash value policy. So you are limited as to which policy based on the company for which the term insurance is written. But again, this is often a very easy thing to do to avoid medical problems in the future. Buy term insurance when you're younger and exchange it or convert it later on in life.
Perfect. I have an interesting question from Ian. It's actually something that I was going to ask in a different phrasing, but he was asking, and I'll send this to Nancy. Can you talk about providing your executor the funds needed to settle your estate? And what I think he means by this is something that I was thinking about as well, which is using insurance to equalize an estate. So it's either having extra cash for perhaps there's an asset in the family that one child is going to be involved in and enjoy, or a business or something like that, but the other two heirs won't be part of, and they want to equalize the estate. And then this is also, extra money to pay the executor, to pay all the bills, and just free up cash. Is insurance often used for any of these types of equalization strategies, or just to have more liquidity in the estate?
Absolutely. So one of the benefits of life insurance is the death benefit is non-taxable, and it also falls outside the will. So it's for the probate fees, it will avoid probate. So one of the ways is possibly not to put the estate as the beneficiary. If you say the estate of is the beneficiary, it falls back into the will. It keeps it safe because then the person managing can't really take it out of the estate. But one of the ways, especially for estate equalization, as you mentioned, Ian, is that I'm going to give one child the shares to my business, But the other two children, they were never interested in the business. So I can buy an insurance policy and 50-50 to beneficiary to the other two children. So that is direct. It pays out very quickly. There's no probate fee and no tax to those two beneficiaries. Whether you can pay it out to the executor, I would be a little bit more careful about that. Of course, when you choose your executor, it should be trustworthy. But when it's a big lump sum of cash, right, I would get legal advice on that and be a bit more careful whether to make the beneficiary your executor. The other thing about life insurance is you can change the beneficiary anytime, and there's no cost to changing the beneficiary. So even though you appoint an executor today, 10 years from now, what if the executor moved away to a different country? What if the executor became incapable? So there's always need to review all of the terms of your estate plan because things change. So appointing the executor as the 100% beneficiary, I'd be a little bit wary about that, because what if you forget to change the beneficiary and they're no longer the executor? Then they got this big gift that wasn't intended.
Good point. Good point. I've also heard of clients who are in a second marriage and have children from the first marriage, assigning and having an insurance policy for that child so that there's no complications with the estate of, with the second marriage. Insurance is pretty useful with a lot of these types of issues that people don't normally think about. They solve a lot of estate problems that can make I would say that all it does is it makes your estate issues less contentious if you have all your ducks in a row.
I'll throw one more idea out. And many people don't know about this, but for family law, when you have a split of marriage and one party has to pay spousal support to the other party, it can be a good idea to have a life insurance in place for that obligation. And we would suggest that the ex-spouse would be an irrevocable beneficiary. So that means that the insured and the owner of the policy cannot do anything, change the beneficiary, cannot take out cash, cannot do anything without that irrevocable beneficiary's okay. So in some way, it just makes sure the ex-spouse, all the obligations of spousal support would be carried out no matter what happens to the insured.
Thank you. So I have a couple questions on this. I have to admit, I actually don't even really know this concept. But the question is if you don't need term to cover your debts, what about infinite banking through cash policies? Who wants to take that one on?
Warren does.
Yeah. Well, I mean, yeah, infinite banking. Infinite banking is a form of leverage of cash value life insurance. So it is a very, I would say politely, it's promoted out there as something that's very attractive. You can find lots of YouTube videos that are proponents of it and lots that are opponents of it. They're really against it. I mean, ultimately, it starts with having a cash value life insurance policy, and that cash value grows over time. The way that they market infinite banking is that you can borrow that money right away and seemingly have endless amounts of capital available, but it's always going to be limited as to how much cash value you have in the policy. So let's talk about what Cindy talked about. If you move some money into your cash value policy, that's typically money that you don't necessarily need to have for spending. Now you're building out that asset class. And then down the road, you may need to have access to that money. So how to get access to it? Well, I can take a cash withdrawal, or maybe I can cancel the policy. Oh, wait, I can leverage it. Now, how do I leverage it? Well, I can leverage it via a policy loan, which is a provision of the policy contract, or I can take it to a bank and I can use as collateral for a bank loan. And then it comes down to what rate am I going to be charged? The policy loan rate's prescribed in the policy contract, the terms are, and the bank loans, or whatever the bank's going to give you. So it's going to be very important to determine what rate makes the most sense, because if the premium loan or the policy loan is 10%, my bank loan is 6%, maybe I'd rather borrow at 6. The proponents of infinite banking will tell you that the interest that you pay on that loan goes back into the fund, which then increases your investment rate, your dividend rate in your policy, which is true. So it's a bit of a self-fulfilling prophecy when people get involved in this, whereby they pay the high interest, which goes into their fund, which they get back. Now, ideally, what would happen is if there are 1,000 people in this pool of policies that are all borrowing, 999 of them would borrow and pay the policy loan rate, and you'd go to the bank and pay a much lower rate. So you get the benefit of it without having to pay the high loan interest rate charge. So the short answer is it's very complex. It's not a one size fits all. And it comes back to what Nancy was saying, and what we're all saying is, do I have the need for insurance? Can I afford to put this capital in there and have it, sort of locked away? And then how can I access it in the future? I just really just try and preach, don't get too caught up in the hype around infinite banking. It sounds great, but there's so many more components to it.
Thank you very much. That one was asked twice by the participants. So thanks for answering that. Another question from Kelly. I think this would be probably good for Cindy. What size of a tax liability is high enough to warrant insuring? I know that's an open-ended question, but
no, it's a good question.
Typically,
it's a good question and easy to answer. I wouldn't necessarily recommend insurance under $100,000, but you can buy it for less than $100,000. The minimum contract that insurance companies offers for $25,000. So that's technically the amount that you can buy. But I will say, buying insurance is like shopping at Costco. The more you buy, the less you pay per can of tuna. So you get more value when you buy higher amounts of insurance, and there are different earmarks sort of that it happens at. $100,000 of death benefit can sometimes be the exact same price as $78,000 of death benefit. So you want to hit those thresholds. The thresholds happen at $100,000, $250,000, $500,000, $750,000, and then $1 million and up. So you don't get much economies of scale once you get past that $1 million mark. If you need a whole bunch of insurance, like $10 million or more, we can get special quotes and even better deals sometimes. So it's not necessarily that the price is negotiable, but there are ways to massage a market price on very large cases. Hopefully that answers your question, but really target if your estate plan says you have a $230,000 estate tax liability, you probably want to ask your insurance advisor for both a $230,000 quote and a $250,000 quote. You should make sure you double check those thresholds.
I'd like to add also, as Cindy said, if you calculate your taxes, that's as of today. We're hoping, especially if you have Genus as your investor, that the thing will grow. So today, that's how much you need, but you might want your insurance advisor to predict out to 20 years or life expectancy. So today you need 230. What do you need in the expectation when the tax is triggered upon death?
Yeah, good point. So that number today could be quite larger in the future, depending on your age and how long you believe that these funds will be invested. And so that's a really good point.
That goes back to one of your previous questions, is how do you make sure you're buying the right product? If you have an estate tax liability that is growing over time because you have a real estate portfolio or a RIF portfolio, corporately held investments that you're not necessarily spending and they're growing, if you know you have a higher future tax liability, a whole life plan is a perfect match for that, because you can start with what you know today, but see that plan grow as your tax liability grows. We don't use term insurance for estate plans. So that tells us, it's pretty easy, actually, if you think about what a client needs to match the right product. I can knock out another question here by David that's just under the question.
Yeah, I was just going to ask you, because this is probably the last question.
Yeah, after I've insured the oldest I've insured is female age 82. That was for an insured annuity.
Hey, Cindy.
Yep.
So to everybody who is wondering which question this is,
Right.
is insurance out of the question if you're in your 80s?
It's not out of the question. It's absolutely possible. Insurance companies still price products beyond age 80. The question only becomes, do you want to pay for it? So, often when asked, when should I buy insurance? The right time is now, because you're not getting any healthier and you're not getting any younger. So if insurance is a thought, you want to look into it sooner rather than later. Don't do the, well, I'm really busy this year, I've got a lot of travel, I'll look at it next year. That could cost you a lot of money.
Thank you. Well,
just quickly on that, Ian, had an accountant asked for coverage for their client on an 89-year-old. And so we went to all the insurance companies and got a whole bunch of quotes. Doesn't make much sense, to which the sort of the case study answer was, try and get your planning done earlier than 89.
Yeah, that's good advice. Well, thanks very much. That's all the time we have for today. For those of you whose questions we didn't get to, I'm actually pretty sure we got to every one of them. But if we did not, we will make sure to have our team have those questions answered directly. Please stick around for a few more seconds as we have some, as we close the session. You will be redirected to a survey, and we'd love your thoughts and feedback on this webinar. Just so we can improve and make them better in the future, and also know what you like and dislike. I want to express my gratitude actually for you taking the time on this lovely day. I can see it's nice and sunny out, so I really appreciate all of you who have spent time with us today. And thanks very much to all of our speakers. Very difficult with 3 panelists on a webinar for an hour. So I think you did a great job of summarizing your thoughts. Genus will be making a donation to the Juvenile Diabetes Foundation, Echo Justice, and the Lions Foundation of Canada Guide Dogs on behalf of our 3 panelists today. And I'd also like to thank all of those who are working behind the scenes. These webinars can be sometimes a lot of work, and especially as we get closer, if we have technical issues, they can be quite stressful for those who are on here and those who are behind the scenes. So thanks very much to all of those at Genus working behind the scenes. We're going to take the summer off for our monthly webinars, so please stay tuned for an email in September, as we will be starting them up again. A recording of today's webinar will be provided to you via email and will also appear on our website in the next few days if you want to revisit and share with your family. Thanks so much for taking the time today, and have a great day.